When you hear roaring 20s, you likely have visions of flappers, jazz music, and the Great Gatsby. Following the end of World War I in 1918, everything seemed to be going well for the U.S. economy. Fast forward 100 years, and the 2020s may have a chance to replicate that historic decade. We're going to break it all down for you right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you very much for joining us. Jason Draho and Paul Zhao are back in the studio. We're going to break down the latest update to the Roaring 20s report. So Jason and Paul, great to have you here. Jason, you and I talked about when you released the Roaring 20s publication a while back, the original draft or the first version. We talked a lot about what it meant and how it played into the decade. And then, of course, we've had a pandemic and all the crazy things that have happened since then. So maybe talk about the recent publication and some of the updates you made and how you're thinking about it when it comes to the decade that we're sitting in right now.
Well, I think first let's define what we mean by roaring 20s. And so, the mind goes, you see like to 1920s, we're probably like a little bit different today, but the way we think of it is this is an economic regime. It's not necessarily called the stock market per se. And what we really have in mind is an economy that's going to grow faster with higher inflation and higher rates, at least relative to the 2010s. Something much more comparable to the 1990s and then in the 2000s. So we kind of formalize like what do we mean by roaring 20s? And you can see that the chart on the screen of GDP growth averaging for the decade around 2.5%. You have inflation between 2 to 3%. You have a Fed funds rate, say between 3 and 4%, and then a 10-year Treasury yield around 4%. So when we did the first report last November, we said like, well, where are we? Well, growth for last year came in around 2.5%, so right in line with the expectations. Inflation is still on the hot side, over 4%. Fed funds rate over 5%. Again, that's likely to come down, but kind of in that range. And a 10-year that finished the year around 3.9%, sort of bang in line. If we assess where we are right now, consensus forecast this year is 2.4%. So again, close to what we're saying. Inflation now a tick below 3%. Again, that's the forecast. We expect the Fed to cut twice this year, so now you have a policy rate a little bit below 5%, and the 10-year again finished a little bit below 4%. So in a lot of ways, it's still very much consistent with the kind of what we lay it out as sort of as a case. So when we kind of assess it, like the conditions right now still very much kind of align with what we think is the attributes of a roaring 20s economic decade.
Yeah, and something that you both write about in the most recent report, and Paul, I'll ask you, is you talk about the likelihood of a roaring 20s kind of hinging on supply side developments, and there are lots of mega trends that play into that. Maybe you could give us a little bit of what those mega trends are and how you sort of see them playing out.
Absolutely. So the first time we did this report, we highlighted several megatrends that we thought would push up the U.S. growth to perhaps operate at a higher level, the roaring 20s kind of level. In the updated version of our report, which just came out, we really take a look and assess how likely this is happening. And in order to assess that, we are using a time-tested economic model called the Solo Swan growth model, which basically says that growth is a function of productivity, capital, and labor. So using those sort of three drivers, we take a look at productivity developments, what capital investment is doing, as well as labor supply. And looking at the chart, a very simple metric, we're more confident in a roaring 20s scenario compared to where we were perhaps 6 months ago. Now, this is still a bull case and not necessarily the base case, but things are operating where we're more confident that the roaring 20 scenario that Jason pointed out is actually happening and could persist. Yeah, you call it a little bit louder, which is the title of that chart, which makes a lot of sense when you're looking at sort of the more optimistic side of the roaring 20s from then till now. And then Jason, you also came up with what you're calling the roar score, which, you could think of the MGM line, you could think of the Katy Perry song Roar, but you've got it used to evaluate the likelihood of a roaring 20s scenario. So talk about the roar score.
So it was kind of based off of what Paul described in terms of a growth model that looks at capital inputs, labor inputs, and sort of productivity for the U.S. economy. So then taking kind of these mega trends we identified, different developments we'd assess, how is kind of this CapEx story that we expect playing out? On the labor supply, is it sort of above demographic trends? Is the productivity trends rates kind of above where we sort of anticipated? So we looked at different factors, do kind of both a quantitative but ultimately kind of a qualitative assessment, kind of like a 1 to 5 score. How high is it relative to what we think is necessary to get this particular kind of roaring 20s outcome? And we compare it today versus last November, we'd say every single metric we think is sort of in line or better. For example, labor supply, because of the high migration, is actually better than we anticipated. The AI investment story is accelerating even faster, so that's sort of a kind of incremental positive. And productivity data we've seen for the past couple of quarters is still holding up and consistent with it. So it gives us confidence that we're as likely to have the foundations for this scenario plan of the rest of this decade. Those are kind of being laid in the way they were in the mid-1990s.
Right.
So marginally more positive, a little bit louder, as you say.
Yeah, and it's one thing like we've been talking about to kind of look at the markets and even the expectations of capital expenditures when it comes to the AI, the artificial intelligence related story. But then there's also the monetary policy side of it, which, as you got both right about in the report, can be a little bit unpredictable, especially when it comes to looking at the likelihood of this roaring 20s scenario. So Paul, is that the wild card, what the Fed might or might not do and what monetary policy looks like from here going forward?
Certainly. I think one of the question marks is actually what policy will do. So right now, we're in an environment where fiscal policy is quite loose. You have deficits around 6% of GDP, but monetary policy is actually quite tight. If you take a look at the chart that we have here, there's really two outcomes that we're predicting. The market expectation is for monetary policy to be slightly easier, and as Jason pointed out, we expect 2 rate cuts before the end of this year. But for the fiscal side to be a little tighter, so smaller deficits as we go forward, especially with the overall higher debt levels and more attention paid onto them. However, we think that there is a lot of pressure on both sides, on the Republican and Democratic side, to keep these deficits quite wide. Mandatory spending is actually quite difficult to cut, and both presidents, I'm sure, would be keen on pushing some sort of fiscal stimulus program because it generally tends to be good for that economy. So it is possible for not only for looser monetary policy, but also looser fiscal policy ahead. It's not necessarily our base case, but we think that it'd be overall good for growth, and that's why we're thinking that it could help the Roaring '20s scenario.
Right. And according to that chart that we just had up there, does the potential of a successful Roaring '20s hinge on having looser monetary policy, like the chart shows, or is it somewhere in between?
I think, as Jason pointed out, we had a framework to look at what capital is doing, what labor is doing, and what productivity is doing. And so we're more confident based on these 3 factors. They're all better than what they were 6 months ago. Now, policy will help or hurt on the margins, and it is a wild card. It is something to think about.
Right. Great. Thank you, Paul. Yeah, and there are plenty of ways to kind of protect your portfolio from risk. Obviously, we want our clients and our viewers to be talking to their financial advisors about those options. So Paul and Jason, thank you for joining. Congrats on the new updated report, which can be found, by the way, everybody, at ubs.com/views. That's our insights page. Thanks again, guys, for joining me. And if you'd like to follow UBS on social media, you can do so by following us on any of those major social media channels, including Instagram. Give us a follow at UBS Trending. And if you do have any questions about your portfolio or anything that Jason, Paul, and I spoke about today, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon.